Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, just a quick question from TJ here, and he says, is a naked option quicker to get out of with a profit? Absolutely. When you're dealing with a strategy that has only one component to it, much easier to navigate your way out of the position. But recognize, and I'm going to bring this to light when we start looking at a couple of our charts here, but understand that particularly in the foreign exchange market, where you've got all of the great benefits, a market that is moving 24 hours a day, that 6 days a week, highly liquid, all of those things that represent great opportunity. Also, you have to understand represent risk. So in other words, if we have a naked put option or a naked call option on any particular security, and it doesn't matter whether it's based on one of these pair values or whether or not it's based on a particular equity option position. The bottom line is, if we have one of those anomalies, say like we had last week, and this is why I believe that this is that the timing for this type of strategy and doing this particular session is perfect, because last Thursday we had a prime example of how these markets can simply, for whatever reason, and we don't need to dissect that, can completely just get out of control. And the idea is, if you were sitting there with a naked put option, and you had just enough money in your account to cover your margin requirements when the pair value, for example, or the underlying security was at the levels on Wednesday, what do you think is happening on Thursday when these markets are going crazy? You're being forced out of your positions, and you're ultimately you're forced to assume a loss on that trade. Whereas if we're using a spread strategy to identify our risk exposure, our capital requirement is less, we know exactly how much we're going to risk, and in the event that we have one of those crazy trading days like we saw across the board, it didn't matter whether it was currencies or whether it was equities, we had one of those crazy days across the board like last Thursday, we know that we have an identifiable risk exposure. So we have to, of course, weigh the benefits, and I'm not suggesting that the proper use of naked options is not something to consider, but what I'm suggesting is that it's very important for us to understand and weigh the risks, particularly in a market environment where we're seeing the type of increase in volatility that we've seen over the last few days. So the other component, as I said, just since I've answered that question there, but we talked about the idea of time depreciation as well, because this is another factor that we want to consider. And what I've done is I've just placed up here a very simple time value premium versus time remaining until expiration scale. And the idea is that the rate of time depreciation is not linear. In other words, it doesn't move in a straight line. The idea is that as we get closer to expiration, you can see just here, and again, it's very generic, but the idea is that if we're 9 to 12 months out from expiration, the rate of time depreciation is going to be slower because the market steps back and says, oh, there's lots of time for this particular pair value to make its move, so the option premium does not lose its time value as quickly as if there was maybe 1 to 2 months left until the expiration date. So when we're looking at utilizing or selecting the appropriate option contract for these types of strategies, we want to, traditionally for us anyways, we're looking to utilize what we would call the front month or the near-term option contract, because that rate of time depreciation is that much happens that much more quickly. So as an option buyer, we look to give ourselves time, at least 3 to 4 months, to take advantage of a directional move. As an option seller, we're looking at taking advantage of a rapidly depreciating time value, and so we want to sell the near-term option contract, and we want to take advantage of that quicker rate of time depreciation. So in other words, the more the underlying security does nothing, the more quickly we get to collect our premiums. So let's look at a couple of examples of these various strategies. The first one that I want to talk about here is the bear call spread. Of course, our outlook in this particular scenario is going to be bearish. We're going to sell the call option at a strike price above the current pair value price and receive a credit. Now, as a naked call option seller, that would be it. That would be, you would be finished with the implementation of your strategy. All you're doing is looking to be a seller of the call option, collect the premium, and receive the credit. But as somebody that's looking to implement a strategy where there's an identifiable risk exposure, there's a second leg to this strategy, and that has us purchasing a call above that sold strike price to limit our potential losses. And we really just have to just go back and recognize what being an option buyer and an option seller means. If I look at my obligation here as the call option seller, I am collecting a premium in order to. I'm being paid a premium to take on the obligation to deliver the underlying security at that specific strike price. So regardless of how high that security moves above my call option, I'm responsible for that difference. And effectively, that's unlimited. When we look to bring that call option and buy that call option above that sold strike price, we've created an obligation here with our sold call option. But when we buy or purchase that secondary strike option contract, call option, we've now identified our risk exposure. We have an obligation to deliver at this specific strike price, but we now have a right to purchase at this specific strike price. So yes, we've limited our and reduced our profit potential. Here we receive a credit. Here we actually have to give up some of that credit. But what we've done is we've effectively now identified our maximum risk exposure. We know exactly how much we're going to make, and we know exactly how much we're going to risk to make that credit before we actually even implement that. Now, just a couple of questions here. How far above the current price? We're going to talk about that in a minute here by looking at a couple of charts. And the other question is, how do you factor the difference between Apple and, I guess, and let me just look at and the Russell to select their strike prices. Well, ultimately, I'm looking at each individual security, whether it's the CDD, which we're going to look at in a couple of minutes, or whether it's the YUK, whether it's the S&P. Regardless of what it is, I'm effectively looking at the price chart. I'm looking at the chart. I'm identifying support and resistance levels. And I'm looking to take advantage of the options that are either above or below. The other consideration, and again, this is why I love these ISE FX options, it's because the strike intervals are very narrow. So in other words, we can create positions with a very limited risk exposure because the strike intervals are go in 50-cent intervals. So in other words, we can actually do 50. We could do 1. We could do 2 points. We could do 2.5 points. We've got a lot of different choices that we can make when we're looking to put together our spread strategy.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.